Investing, it's a word that sparks excitement and dreams of financial freedom. Like a roller coaster, the world of stocks and crypto offers thrilling highs and stomach-churning lows. Fortunes can be made, but sadly, many new investors end up losing money. Why? Let's find out. Imagine this. You hear stories of people doubling their money overnight with Bitcoin. The fear of missing out, or FOMO, kicks in. You jump in head first, only to see your investment plummet the next day. Sound familiar? This is a common scenario, and it highlights the importance of understanding the risks involved before you start. Remember, every investment involves risk. Understanding these risks is crucial for success. Just like you wouldn't board a roller coaster without knowing how safe it is, you shouldn't invest without understanding the potential downsides.
Welcome to the AI Duo channel. Stick around, and if you like our content, don't forget to subscribe, share, and like our channel.
So, what are the common mistakes that trip up new investors? Firstly, many dive in without doing their homework. They invest based on rumors or hot tips, without understanding what they're buying into. This is like baking a cake without a recipe. Disaster is almost guaranteed. Secondly, emotions often cloud judgment. Fear and greed can lead to impulsive decisions. Seeing your investment drop can be scary, prompting panic selling at a loss. Conversely, greed might tempt you to chase quick profits, leading to poor choices. Lastly, overconfidence can be a recipe for disaster. Beginners might experience initial success, leading to an inflated sense of expertise. They may take on more risk than they can handle, believing they've cracked the code. However, the market is a fickle beast, and what goes up must come down. The stock market and crypto in particular are known for their volatility. Prices can swing wildly, both up and down in short periods. This unpredictability can be unnerving for seasoned investors, let alone beginners. Imagine trying to sail a small boat in a stormy sea. The waves are high, the wind is unpredictable, and one wrong move could capsize you. That's what navigating the volatile market can feel like for new investors. This volatility is driven by a multitude of factors: economic news, political events, investor sentiment, and even social media trends. Understanding these factors and how they influence market movements is crucial for making informed investment decisions. So, how can new investors avoid these pitfalls and navigate the turbulent waters of the market? Firstly, education is key. Take the time to learn the basics of investing, understand different asset classes, and research potential investments thoroughly. Secondly, start small and set realistic expectations. Don't expect to get rich quick. Investing is a marathon, not a sprint. Begin with a small amount you're comfortable losing and gradually increase your investments as you gain experience. Thirdly, create a solid financial plan. Determine your investment goals, risk tolerance, and time horizon. This plan will act as your roadmap, guiding your decisions and keeping you on track. Finally, remember that investing is a long-term game. Don't panic sell when the market dipped. Stay patient, stick to your plan, and ride out the storm. Investing, like any worthwhile endeavor, requires knowledge, patience, and discipline. By understanding the risks, avoiding common mistakes, and following these tips, you can increase your chances of success and turn your financial dreams into a reality.